Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's check out the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered out to a licensed professional. Pargamonic to the stage.
Oh, hey, Will, how are you? Good. How are you doing, Will?
Good.
Let me share my screen here. And what we'll do today is cover, a tool that we covered before, looking at the different types of option spreads, multi-leg trades that are trading in the market to get insights, generate potential trade ideas, or find maybe specific opportunities that you might be looking for. So let's go to the screener, and under screeners up top, if we go to, under screeners, hold on one second, Will. Screeners, multi-leg trades. For some reason, there we go. Hit on the multi-leg options trade screener, and you will come to this page. And here, what you'll see up top are filters, and then below you have this data table with different items in it, and these are aggregated trades that we compiled from the options trade tape. The system looked at the multi-leg trades, stitched them together, analyzed them, and then made this interpretation of what the strategy of the multi-leg options trades. So here we could see from left to right, you have the symbol, the times that these particular trades occurred. So sometimes you could have a certain, like a put spread or call spread, but it could trade multiple times the same call spread in the same day. So we compiled all that and aggregated together, and here shows the timestamps from the first trade. Like, for example, here in IWM was at 9:48:11. The last trade in this particular strategy was 3:20:23, and over here you could see here the interpretation. It was a put spread, May 16th, 175, 177 put. Okay, this is the total number of contracts involved in this spread. So it's a combination of both options, and we saw this trade 13 separate individual times throughout the day. Okay, if you open this up, you'll get more details on this trade. So you could see here in this table, these are the 13 times this traded: 9:48, 2:14, 3:20. This is the price, the bid and ask. And if you click on the details, it opens up the legs of the trade. I'm going to close this for now. And over here, we give some additional details surrounding the trade. So this is the days to expiration. Makes it easier. You do have the expirations listed here, but if you're just scanning down the table, and you could expand this table, we're just looking at the top 5 over here. This lets you see how far out this expiration is relative to days to expiration. Over here, we see there's a time spread here, or a diagonal spread. So you have a days to expiration 60 and 116. Okay. Additionally, this information shows you the difference between the strikes in the spread. A lot of times the spread are call spreads, put spreads, even diagonals. So here, just to make it easier for those types of strategies, we show the difference between the two strikes. So over here, May 16th, 174, 175 put spread. The difference between the strikes is $1. This one, May 16th, 175, 177 put spread. The difference between these two are $2. These are other indicators here, but I'm going to just kind of go over that another time, just because to save time to do a screen. Then we have here these aggregated prices, and these are VWAP prices. This is the VWAP price of all these spreads that traded on the day. So you could see here this particular one in IWM, the May 16th, 175, 177 put spread traded 13 times for a volume weighted average price of 52 cents. So 52 cents is taking into consideration all those 13 trades multiplied by the volume of the trades and then taking the volume weighted average price. Okay, so if you had one trade that traded 1,000 times, that would get more weight than if another trade only happened with 2 contracts. So 1,000 contracts gets more weight than 2. This is also the bid and ask, also using the volume weighted prices, and this is the stock reference using the volume weighted prices, all the same methodology. So now we get a sense of, okay, what kind of happened in this put spread? It looks like the majority, the volume, based on the volume traded closer to the bid at the time, 52 cents versus the market 51 cents, 56. And the stock price, if we use the VWAP, the volume weighted based on those trades, was 184.31. So we get an idea now where the stock was during the time that these traded, and the traded price relative to the displayed bid and ask markets. Okay, and how can we use potentially this information? Well, one is we kind of see where the trades or the transactions are happening relative to the bid and ask prices. Okay, so most of it you could see is right near the bid, and that could serve two purposes. One is that maybe if you're looking to buy a spread, let's say you were interested to buy it, well, now you get a sense of maybe, hey, I could get it below mid price. It's trading near the bid. There's potential to price improve for a put spread that I'm trying to buy. And if this put spread fits my outlook, or if it fits my portfolio, or if it helps me out, or I feel like that there's edge in this put spread to begin with, well, now I kind of get a sense of like, hey, maybe take a look at, this put spread is trading, and I could potentially improve my price, even with some edge. If we use the midpoint of the market, the mark to market, as the fair market value at that moment, then buying it below that midpoint would certainly be beneficial, right? That would be at least some edge relative to the mark to market. And if you're looking to sell, you could look for other ones maybe to sell that are closer to the offer that fit. Or even if you agree with this one and you think it's happens to be overpriced and you're a seller, well, now you have a sense of where the markets are trading in this particular option, or in this particular spread. So let's say we are looking for a particular, let's say we are interested in a specific strategy, because this lists all the strategies right now and it's sorted by the number of contracts. So you could see here, MGA had the most contracts involved in the strip strangle. But let's take a look at maybe something this is a list, strategy types of spreads that we detected. And let's say we were looking for a calendar call spread. That's what we're interested. That's what we're trading. Maybe our outlook right now has to do with term structure, and we think maybe that volatility will increase in the future, decrease, or whatever it is. But that's the strategy we're interested in. So let's filter out all the other strategies. Let's look at calendar spreads alone, calendar call spreads. Let's just look at those because we want to see what other people are doing. What are they trading? What are the prices they're trading at? What are where's most of the action? Where's most of the volume? Which stocks can I take a look at where there's already trading going on and I might be able to participate in it. So we're trying to generate potential trade ideas, right? So let's click on calendar call spread, and now what it'll do is retrieve, the stock symbols that we detected have calendar call spreads, and it will detect, and it'll list it by largest volume. So let's click on that. And now you see the calendar call spreads. See, so strategy type, these are all calendar call spreads. And, based on yesterday's data, we're not open yet today, but you could see they're over 189 that we detected. So you could tab through them if you want. Right now, it's sorted by the ones with the most volume, most contracts. So TLT, the ETF, if you click on this info sheet, it'll tell you more about this stock. Okay, so we'll see in TLT, there was a calendar spread. It was the May 16th, May 30th, 93 call spread. So calendar spread, we talked about this yesterday. It involves two different expirations on the same strike. So it's same strike, two different expirations. This one is the May 16th, May 30 call spread. Over here, it's easy to see that the first expiration has 25 days to expiration. The next one has 39 days. And what was the price of this? Where did it trade? Right? We know, it traded 11 times. Okay, 11 times between 1105.35 and 1105.50. The average weighted price, volume weighted average price was 16 cents. Okay, relative to the bid and the offer displayed at the time, the market was 16 cents, 19 cents. So traded on the displayed bid for that spread with the stock at 86.66. So here, a couple insights are that this spread is looking at the 93 call with a strike price of 86.16. So if you're buying it, right? If you're buying this spread, that means you're buying the May 30, selling the May 16th. What we know is that you'd have a bullish outlook on it because the stock's 86.66. Well, ideally, your sweet spot is that on May 16th, this stock price is at 93, right? Because the May 16th call will expire worthless that you sold, but the May 30th call will be right at the money where the time premium is the highest. So you do have a bullish outlook on the stock, and as a buyer of the spread, you believe that the implied volatility May 30th has a chance to increase. right, relative to the May 16th. So you want May 30th implied volatility to increase. And the opposite if you're selling it. If you're selling it, you want this spread on May 16th. You want the stock to be far away from the 93 strike, right? You want it to be far away because then this May 30th will decay, you know, and the spread will be, you know, worth less. So you want it to be either, you know, way away from the 93 strike, you know, to the downside, or way away to the upside. But you want it to be away because 93 would be the place where it, you know, it would be the worst spot price for you. And you want the implied volatility on the May 30th to go down, right? So if you're selling May 30th by May 16th, you want implied volatility to come in. So these would be the two different outlooks depending, you know, which side of the spread you're doing. And this also helps anybody looking, for example, if you're looking to buy a call spread that fits this criteria, right? Then you could see that, hey, well, maybe here is a spot because I could get it closer to the bid, right? If you're looking at it from all this fits the criteria I'm looking for, I like this spread, I think there's already edge in the spread. Well, I could also potentially get a better price because there's already activity on there, there's trading, and I could see where the trades are happening relative to the bids and offers. So now I could make more informed decisions, right? I could try to maybe see if I could get it on a bid, or maybe 17 cents, you know. But now I have that information. I can make a more informed decision, getting better execution, getting better prices. Let's say we were interested in all the TLT spreads. Well, maybe not only this, but what else is happening? So we could go into the search box and just type in the symbol TLT. And now we have calendar spreads, because keep in mind, this feature up here, this filter is still set to calendar call spread. But now I added another in the search, symbol TLT. So now I have all the TLT calendar call spreads. So if that's all I'm interested in is calendar call spreads and TLT, I could just do it this way. And now I see all the different ones. Here's another one, May 16th, May 30th, but this is the 88 strike call. So this is more closer to the at the money. You can see that traded at 41 cents. Here's another one, April 28th, May 16th, that traded on an 89 strike call. So this has 7 days and 25 days to expiration. And this traded at 64 cents with the stock at 86.16. So that's a quick way to use a screener that looks for multi-leg trades. Okay, this is looking just for multi-leg trades, and looking at what are the type of strategies people are using, and where are these prices and the volumes trading in the market. And if you wanted to change the symbol, let's say we're looking for, I don't know, let's see, SPY. So now we have all the SPY calendar spreads that we detected. So you could see the top one, 2,000 contracts, was the April 25th, May 9th, 550 call. So this has 4 days and 18 days to expiration, and that traded at $1.94 with the stock at 516.82. So I think that, you know, I covered a decent amount just focusing on, you know, one spread type and changing the symbols, but the same idea goes for other spread types. You know, you could release this and just pick different types of strategies, that we might be looking for. Here's a calendar call butterfly, calendar put ladder. And again, once you use that filter, it will filter out those types of strategies. All right, so I'm going to stop right there. I think we had a good overview of that page.
That was great, D. Thanks so much for bringing this informative webinar on how to screen for multi-leg options trades. Thanks everyone for joining. Remember to like us and follow us on all the social channels. Give us a thumbs up if you're on YouTube right now. Big smile if you're on LinkedIn. Everyone have a great day. Thanks so much, D.
Yep. Thanks, Will. Thanks everyone for joining. Stay safe out there. Have a great trading day. And we hope to see you tomorrow.
All right. Trade in peace, chameleons. Everyone have a great day. Bye-bye.